On Business Incorporated today, Zambia expects boost in investor confidence after $1.4 billion IMF deal. MTN Uganda shares jumped 3% after listing on Ugandan bourse. And South Africans protest against shale oil exploration in pristine coastal area. All right, let's kick off with the markets, starting off with trading activities from major equity markets here on the African continent. Nigeria's NGX and South Africa's indexes traded in different territories at intraday. The NGX was down marginally by 0.05% after last week's negative performance. It was red trading all through, while South Africa's GSE index looking good, up 0.39%. Egypt's EGX 30 was in the red, down over 0.5%, while the Nairobi Stock Exchange closed Friday's session in negative territory, down 1.36%. We cross over to the Middle East, where major equities were mostly in positive territory at intraday. The Abu Dhabi index was up 2.41%. Dubai's index also looking good, up over 2%. Still within the region, Saudi Arabia, it's in the green, up 0.21%, while the Qatari index is the lone downer, marginally by 0.04%. And in Europe, stocks have been volatile because of concerns of the Omicron variant. The IMF chief, Kristalina Georgieva, has warned that this could slow the global economic recovery. But let's see how the week has kicked off with Chris Koba right there in Berlin. How have European markets kicked off the week, and what will investors be looking at in the coming days?
Well, quite a beat after Friday's somber session. The German DAX started the week with gains, so volatility really remains the word of the hour, and indeed investors were having to digest a data shock earlier today. German industrial orders have steeply dropped for the second time in just a couple of months. They were down almost 7% in October compared to the month before, so that's not year on year, but compared to September. What's behind it? Well, there's much less demand from foreign customers. Orders from outside the country were down more than 13%, and from outside the European Union by more than 18%. Analysts say the rising coronavirus infections in Asia, mainly China, and the subsequent caution of many companies can be seen in this data. Domestic orders were up by around 3%. Right now, order books of German companies are still full, but there's concern then that disruption in supply chains and an ongoing shortage of commodities and vital parts could really put the brakes on production and thereby the economic recovery. Apart from the developments in the pandemic, investors will also be eyeing Chinese real estate developer Evergrande, which is again on the brink of default. It says there's no guarantee it can meet a crucial $82 million payment. Also tomorrow, there'll be data on industrial production in Germany, and on Friday, inflation data in Germany and the US. And of course, there will be a fresh German government, with Social Democrat Olaf Scholz expected to be elected chancellor by the German parliament on Wednesday, ending 16 years of Angela Merkel as the country's most powerful politician. The agenda of the new government: well, more affordable housing, more digitalization, more modernization. Investors, and we all for that matter, will be keeping an eye on whether that'll happen.
Right, and it's also been a wild weekend for cryptocurrencies. Are you keeping an eye on that, and how are they faring today?
Well, the uncertainty about the larger impact of the Omicron variant remains, but the biggest concerns seem to ebb on Monday. That's why cryptocurrencies did find some footing after what was indeed a wild weekend, with Bitcoin at one point losing more than 20% of its value and trading as low as $41,900. Bitcoin found support at around $49,000. We do know that cryptocurrencies like Bitcoin are prone to wild swings, And then there's the fact that Bitcoin set a record of more than $68,000 just a couple of weeks ago. So a drop in value isn't that surprising, as there is some profit taking. And it's not only the worries about the Omicron variant that has been putting pressure on currencies. A mixed U.S. jobs report last week did little to shake market expectations of a more aggressive U.S. tightening, and the consumer price report due on Friday looms as another case for an early tapering and a stronger U.S. dollar. But again, cryptos were able to stabilize somewhat. Earlier observations of the Omicron variant in South Africa suggest that those infected suffer relatively minor symptoms compared with previous virus waves. Omicron headlines are moving in the right direction, and the risk of sentiment may ease off soon, some analysts said.
Right, and in an attempt to break a surging fourth wave of infections, Germany has introduced tougher measures for its citizens, but the more stringent rules are putting off shoppers. A retailer group actually says. Tell us more about this.
Well, the introduction of tightened coronavirus measures in stores is a, quote, dramatic disruption to the Christmas shopping season, says the German Retail Federation. As in most other Western countries, the current Christmas period is a key sales season. Now, the German federal leaders and state leaders agreed last week that to require stores selling non-essential goods to only open their doors to those who can prove they are vaccinated against or recovered from COVID-19. Now, German retailers are getting worried that these restrictions are going to make a significant dent in profits. And there are first indicators. These restrictions have led to 2 slow weekends during what is normally prime shopping time, business owners said. A survey by the Retail Association of about 1,600 businesses showed that sales in brick-and-mortar stores selling non-essentials had declined by 26% compared to 2019, the year before the pandemic hit. Under the current rules, visitor numbers in city center trade have fallen an average of 41% compared to 2019, the group also says. Many merchants already saw sharp sales drops during 2020. That's when Germany was also battling the pandemic. For example, many clothing and department stores had to shut down in the second half of December last year, facing a second holiday season. Now, with dwindling sales, the Retail Association has renewed its demand for more financial assistance to the stores that are impacted.
All right, that's Chris Kober right there in Berlin. Thank you so much, Chris. Well, in the UK, there are indications that supply chain problems, rising costs, and ongoing COVID-19 restrictions could lead to shortages of goods and services and higher prices over the Christmas trading period. Well, let's hear more now from Juliana right there in the UK. Great to have you, Juliana. Well, a supply chain problem, rising costs, and ongoing COVID-19 restrictions, these might be a trilemma that could lead to shortages of goods and services and higher prices over the Christmas trading period. Can you bring us up to speed with the situation of things right now?
Yeah, absolutely. It doesn't sound great. A trilemma. I've never heard of that term before, but it certainly seems as if it is one. Accountancy firm BDO, they've conducted a survey where they've spoken to 500 small to medium-sized businesses, and we know that SMEs are really the engine of any country. And what these companies are saying is that they're struggling. 4 out of 5 of them has said that they are starting to see supply chain constraints really hit home. The energy wholesale gas price, which we haven't spoken about for a couple of months, is still really hitting these companies, and they are starting to say that it's trickling down to the consumer because they can't keep up to pace. We are, of course, we're not approaching, we're in the most important season for some businesses. Christmas season is a time where you'd hope to rake back some of the losses that you had occurred in the year. But for these SMEs, it's not just losses that have occurred in 2021, it's losses that they've occurred over the past 2 years because of COVID. And now, of course, we've got this Omicron variant. I was just hearing in Berlin some of the statistics and the wordings we're getting out of the World Health Organization, and particularly South Africa, is that it isn't as deadly as one would have thought. But because of some of the mixed messaging that we've been hearing, particularly from the government here in the UK, lots of people are concerned. People are staying home. People are not going out, spending as they would. Lots of Christmas parties have been cancelled. This is affecting these industries. We have had some PMI data. The PMI obviously has a forensic look at the private sector here in the UK. Not that bad. Services sector was up. Manufacturing and construction just being in this morning, that was higher than it was last month. But the highs that we were seeing in the summer when we first started to reopen some of these restrictions are just not there. So it is a concern. Earlier this morning, the Confederation of British Industry, which is Britain's biggest business lobby group, they downgraded their forecast for this year, also downgraded the forecast for GDP next year. So not great, but we do still have a couple of weeks left this year. And of course, we are getting that all-important GDP data for October on Friday. And this will give us an indication to just how this fourth final important quarter is going to bear in the UK.
Pretty important quarter. Well, I guess it's all about caution right now with this variant. Well, meanwhile, Tesco could face empty shelves over pay dispute. What are the key issues here for Tesco?
Money is the key issue, which is why members of the Unite trade union are going to strike. They've confirmed that they'll be doing that. There are about 1,000 workers working in warehouse and distribution, really important staff. They're just not happy with the 4% pay rise that Tesco have given to workers. They believe that's well short of the rise of the level of inflation. I believe Unite are going with the retail price index, the RPI, which is a bit higher than the CPI. The RPI currently stands at about 6.2%. CPI currently stands at about 2.4%. But yes, they're not happy with the 4%. They just don't feel that they're being compensated enough, particularly over the past 2 years, where it's been very, very tough for staff working in essential services. They've gone above and beyond, which is why they're deciding to strike. So from the 16th of December, I believe for 24 hours, although that could be extended after the Christmas period, they will be, dropping the job. They won't be working. This is likely to affect some shoppers that are working in those areas. We're not yet sure how this is going to affect the specific Tesco stores around the country, none of them being in London. But Tesco have come back to refute some of the claims that the trade union have said, saying that, they are offering a pay rise more than what they've offered in 25 years. So the dispute continues, but the trade disruption is still ongoing.
Quite interesting. I see the UK's FTSE 100 index jumped by about 45 points in the morning. Bring us up to speed with intraday market numbers.
Yeah, still very much in the green. The FTSE is doing well at the start of the week. Surprise, surprise. Aero, travel and leisure stocks are the main risers. Unfortunately, for those hoping there would be a change, it seems as if BA owner IAG, their investors are pretty happy. Their stock is up 2%. Also as well, Intercontinental Hotels Group, their stock is up by about 1.7%, and that's led the FTSE. Also, we had a bit of positive data from the Society of Motor and Trade Manufacturers showing that UK car sales are finally up. They've been down for the past 4 months, and that's affected the square mile today. The FTSE All Share is up 0.71%. The FTSE 100 is up by 0.65%, and the FTSE 250 is up by 0.48%. In the currencies market, the British pound is also trading up against the US dollar by 0.16%, and it's also trading up against the euro by 0.19%, and also it's up against the Japanese yen by 0.33% at intraday, Laddie.
Quite impressive. All right, Juliana, thank you so much. Enjoy the rest of your day.
You too, thanks.
All right, we'll take a break now. When we come back, we see an approval for $1.4 billion credit facility for Zambia by the International Monetary Fund. It's expected to boost investor confidence. We'll be talking about that after the break. Do stay with us. Welcome back. You're watching Business Incorporated live on Channels Television. Now to our next conversation. Well, approval for a much-needed $1.4 billion credit facility for Zambia by the IMF is expected to boost investor confidence and unlock further financing facilities in the aftermath of a debt default by the southern African country. Zambia, under President Hakainde Hichilema, following the ouster of former leader Edgar Lungu, been hard-pressed for external financing after it's defaulted on a $42.5 million Eurobond coupon repayment at the end of last year. Well, let's see what this deal means for the country. I'm being joined by practice leader, Sub-Saharan Africa at Frontier View, Matt Kindiger. Great to have you, Matt.
Hi, thanks for having me on the program today.
Yeah, so how will the IMF deal affect the government's ability to negotiate with creditors and exit a default?
Yeah, so this is a very significant deal and certainly a step in the right direction. It's worth remembering that this is a staff level agreement. It still needs final approval. In our view, it will be approved and confirmed. So generally that is positive, but it's also worth remembering that this comes in addition to over $1 billion that the Zambian government received from its SDR allocation earlier this year. So Zambia, by the beginning of next year, will have received over $2 billion from the IMF. In terms of what this means for Zambia's debt restructuring prospects, certainly it is positive. Zambia's current total government debt is over $27 billion. That's over 100% of GDP. More than 60% of this is international, and more than 10% of this is held by commercial bondholders. So certainly this is a step in the right direction. What this will mean is that the Zambian government will have more leverage when it comes to debt negotiation or debt restructuring negotiations, including with bilateral lenders such as the Chinese, as well as private sector bondholders. So we would expect to see some progress in 2022. But in terms of Zambia being able to exit default, this really does depend on the implementation or the effective implementation of the restructuring of public finances and the conditionality associated with this latest IMF deal. But crucially, the state of public finances will still continue to be determined by copper prices and copper production. These remain incredibly important in Zambia in terms of the government's ability to raise public finances or raise tax revenue, but also instill confidence amongst lenders that will be lending to the government. So certainly a step in the right direction, but there are a lot of things that need to happen before we see Zambia exit default and stabilize public finances.
Well, they have their job gone out for them with this one. How has the private sector, responded to Hichilema's presidency, and what does this mean for the country's growth outlook?
Certainly, Hichilema's presidency has been welcomed by the private sector, and this is because he's generally viewed as taking the right steps in terms of improving governance standards, overhauling public finances. This latest IMF deal sends a very positive signal to investors, but also companies operating domestically in Zambia. What we have seen in terms of sentiment indicators such as the Purchasing Managers Index, which is a survey of the private sector in the country, what we have seen is positive numbers emerge from Zambia recently, and this is after a very long period of very clearly negative sentiment. So this reflects the country's improved governance outlook, but also what we're seeing as a result of higher copper prices. So Zambia is, a big miner, a big copper producer. So certainly the private sector is a lot more upbeat about the country's prospects as a result of the elevated commodity prices. However, there is still some skepticism in the private sector around what the IMF deal means for the country's outlook and the operating environment for them. So, for example, the IMF may include in its conditionality the requirement of withdrawing certain subsidies, such as farming and fuel subsidies. If this does happen, it is beneficial for the government's public finances. However, it could affect the operating costs for companies. It could affect sentiment in sectors like farming, and it could also raise the cost of doing business because of higher fuel prices. So certainly there is a degree of concern and skepticism there. In terms of the country's growth outlook, so the private sector is more upbeat. We are expecting the private sector really to lead the growth outlook, will be the main driver for growth next year. But really the most important thing in Zambia is the copper price and copper production. The government has the ambition of tripling copper production over the next 3 years to 3 million tons per year. And if this happens, Zambia's economic prospects are relatively bright. But if copper production disappoints or copper prices fall over the next year or so, then we would expect Zambia's economy to struggle. So our base case view is that the economy should grow by about 3% next year.
I guess that's one of the challenges of over-dependence on one asset there. Well, the kwacha has strengthened considerably since Hichilema became president. Where do you see it heading over the next year?
Yeah, certainly. So the kwacha has outperformed expectations, supported by a much more upbeat investor view towards Zambia. So Hichilema has encouraged some portfolio inflows into the country. We've also seen the SDR allocations from the IMF earlier this year supporting the country's forex reserves and also higher copper prices. That has also bolstered the kwacha. In terms of the outlook, so the kwacha has started to depreciate again, and we are expecting some gradual depreciation throughout 2022. And this is going to be driven by increasing demand for imports as private sector sentiment increases. And generally, this won't be matched as immediately by improving export revenues. However, if copper prices remain elevated, and if they continue, if they increase from where they are at the moment, and if exports, especially copper production and copper exports, increase beyond expectations, then we could see a further strengthening of the kwacha. In terms of our view, so we would expect an annual average of about 19.9 this year and 20.6 in 2022. So very moderate depreciation, quite considerable stability, and this is quite an improvement on the recent experience of the kwacha in Zambia. So although we are expecting some depreciation, certainly it will be a much more stable currency environment in Zambia, especially compared to the last couple of years.
Okay. All right, Matt Kinniger, practice lead, Software in Africa at Front of You. Always great to have you on the program. Thank you so much.
Thanks very much.
And MTN Uganda shares rose 3% today on its first day of trading on the Ugandan bourse after its initial public offering to sell a stake in the company. The telecom operator, a unit of South Africa there launched its IPO offering in October, aiming to sell a 20% stake, pricing the $4.5 billion shares on sale at the 200 shilling each. Results of the IPO on Friday showed MTN Uganda had secured just 60% of its target amount, raising 536 billion Ugandan shillings. It's about $151 million. The MTN Group's shareholding fell 83% from 96% with the listing. And South Africans took to the beaches on Sunday to protest against plans by Royal Dutch Shell to do seismic oil exploration. They say will threaten marine wildlife such as whales, dolphins, seals, penguins, pristine coastal stretch. South African court on Friday struck down an application brought by environmentalists to stop the oil major exploring in the eastern seaboards. Wild Coast rejecting as unproven their argument that it would cause irreparable harm to marine environment, especially migrating humpback whales. Well, the Wild Coast is home of some of the country's most undisturbed wildlife refuge, and its stunning coastal wilderness is also a major tourist draw. At least 1,000 demonstrators gathered on a beach near Post Edward, and Shell said on Friday that its planned exploration has regulatory approval and will significantly contribute to South Africa's energy security if resources are found.
It's actually just horrendous that they're even considering this. I mean, if you look around, you look at these people, you look behind us, you look along the coast, it's unacceptable and it's not going to happen. We will stop it. Everybody will oppose this.
And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.